This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
The question I'm going to look at is well may. And well may is question 2 from the June 2007 exam, paper F7. But here I am, I'm in my 15 minutes of reading time. I can see that question 2 in the exam is a standard one. Read the requirement. The requirement says redraft the financial statements, including a statement of changes in equity. Including a statement of changes in equity for the year to March 07, reflecting the adjustments required by notes 1 to 7. So it's an income statement, a financial position statement, and a statement of changes in equity. Calculations to the nearest 1,000. Okay. Right, well, often in these questions you'll find that the easier notes, there are 7 notes to the question, the easier notes are the, do I want to change the colour scheme now? The easier notes are the ones at the end. So question 7, note number 7, says the bonus scrip issue on the 15th of March, and we're going up to the 31st of March. We made a bonus issue from retained earnings of 1 share for every 4. This issue has not been recorded in the draft financial statements. Okay, so point number 7, 1 for 4. Now looking at the numbers, we've got equity shares of 50 cents each for 1,200,000. We can do this the long way or the short way. We can say that this is the long way, $1,200,000 worth of 50 cent shares is 2.4 million shares. And we've got a bonus issue of 1 for 4, so we're going to have an additional shares of 600,000, so we're going to finish it with $3 million worth on the balance, 3 million shares on the balance sheet, or $1.5 million worth on the statement of financial position. That's the long way of doing it. We can see therefore there's a difference of 300,000 or 600,000 shares at 50 cents each, but there's such a waste of time. We start with 1.2. We're going to issue a 1 for 4. That means we're going to have an additional $300,000 worth to close me with $1,500,000 worth. So, long way and a short way. This is the important figure. We're going to increase share capital, and we're going to decrease retained earnings, and that, of course, is going to affect our statement of changes in equity. Okay, point number 6. I'm writing 4. Point number 6 is carrying amount of net assets is 600,000 higher than their tax base, and the rate of tax is 35,000. This is a deferred tax thing, and the income tax charge of 360 does not include the adjustment required. If we look on the income statement, there's 360,000. That's the charge for the year. It does not include the adjustment required to the deferred tax provision, which needs to be charged in full. And next time that comes up, I'm going to say I don't want to see it again. I don't like these pop-ups, they annoy me. The income tax charge does not include the adjustment required to the deferred tax provision. It should be charged in full to the statement of income, so there's none of it is going to go to any revaluation account. The deferred tax on a revalued asset would normally go to the revaluation reserve, but this time it's not. It's going to go fully to the statement of income. Okay, 600,000 higher, and the tax rate is 35%. It's telling me therefore 35% of 600,000 is 210,000, and that's therefore the deferred tax balance that I want to carry forward. And at the moment I have a deferred tax balance brought forward on the draft accounts shown to me, deferred tax brought forward of 180,000, so I need an additional 30,000 deferred tax additional charge to the income statement comprehensive income. So what I'm going to have there is an increase in the tax expense and an increase in the deferred tax liability of 30,000. Okay, that deals with point number 6. Point number 5, this always causes problems. It's a convertible loan. It's got an 8% rate, but in fact, if you look at the bottom of the paragraph there, the equivalent loan without the conversion option would have carried an interest rate of 10%. So it's got a realistic, a proper rate of 10%. It's a mixed instrument from what I can see. The present value of a dollar receivable, we're going to have to apply discounting. So let's see what we've got. It's got a face value, nominal value of 600,000, and it's got an 8% interest rate. And do I want to see this again? Change the colour scheme, keep the colour scheme, but ask me again if my computer continues. Keep the colour scheme and don't show me this message. Let's do that one, shall we? Okay, so here we are with 8% and 10%. We need, it was issued in April X6 and we're going up to March 7, so it's a full year. That's important because of the amount of interest which has already been charged in the finance charges. So for the year to 07, and it's redeemable on March 10, so 07, 08, 09 and 10 is the 4-year life. And we're going to be paying out 8% on 600,000, which is 48,000. The 48,000 and 48,000. But in the year 2010, we're also going to have to pay the nominal value, so that has to be 648,000. Okay, this is a realistic rate of interest, and so we're looking at the 10% discount factors, and we're given those, which is very kind of him, very kind of Steve Scott to give us the discount factors 8, 3, 7, 5 and 6, 8. Let me just remind you, and just in case he doesn't give us the discount factors, to calculate it's 1 divided by 1 plus r to the power n. So 1 divided by, and the interest rate is 10%. So 1 divided by 1.10 is the year 1. And then 1 divided by 1.10 would be for the second year. And if you just put that in your calculator, you put that one in your calculator, 1 divided by 1.1 equals, that gives me 0.90909. And if I divide by 1.1 again, that gives me this one 0.82645, and he's rounded us to 91 and 83. But that's how we do apply the discount factors. That's how we calculate the discount factors, just in case he hasn't given you the figures. I'm going to take these away now. I'm going to rub these out, and we'll just do the calculation for these. 48 at 0.91, 48 times 91 is 43,680, and if I multiply that by 0.99, that gives me, is that 39,709? No, we'll do it properly, 48, because I've done it rather accurately. 48 times 83 is 39,840, 39,840. And times 7.5, that's 36,000. We do that one in our heads, can't we? And 648 times 0.68 is 440,640. That gives me a value there of 612, that's 210.19, carry 115, the 559. I've done the figures right now. 75, 36, 14, 20, 210.19. I don't think that one's right, is it? 48 times 83 is 39,840, not 38,840, and that gives me 560. And we're working to the nearest thousand, so 560,000 is the value of the loan, but it's got a face value of 600,000, so that therefore must be equity, and that gives me the 600,000. Now then, that's not all we've got to do, because if the loan is only 560, then the interest, the finance charge on the loan, is only going to be based on 560. And so what we now have got to do is think about this. 10% of 560, which is the realistic rate if it didn't have this conversion option, is 56,000 for a full year. This is where the date of issue is important, but it is for a full year. Actually, paid, according to the question, is 48,000. So there's an additional 8,000 finance charge needed. And that's going to increase finance charges and therefore decrease the profits. And it's also going to increase the value, the face value of the loan. So we're going to have the loan shown. At the moment it's shown as 600,000. It should only be 560, but now it's also got this additional 8,000. So on the balance sheet, on the statement of financial position, we're going to find 568,000. We're going to have an increase in the finance charges within the statement of income, and we're also going to be showing 40 additional in the equity section. Alright, point number 4 tells me the retained earnings is made up of 2615 and 635 profit for the period, and the dividend of 400. That's going to appear in the statement of changes in equity. There's nothing to do there for point number 4. Just need to make an adjustment. I'll put it in. We need to adjust the profit for the year. But that's all there is in point number 4. There's nothing else for us to do. Number 3, the non-current assets. We've got 2 properties. One's a factory with office accommodation used as a production facility. So this is our production facility with the office, and it's therefore not an investment property. The other one is an investment property. It's leased to a third party under an operating lease. We revalue all our properties to current value at the end of each year, and we use the fair value model in investment properties IAS. Relevant details of the fair values of the properties are, so we revalue all our property to current value at the end of each year, and we use the fair value model. Okay, let's have a think about that. The valuations to March 07 have not yet been incorporated into the financial statements. Factory depreciation for the year ended 07 is 40,000. That's charged to cost of sales. As the factory includes some office accommodation, 20 of the depreciation should have been charged to operating expenses. Okay, so we've got the 40,000 depreciation so far in cost of sales, and we're told that 20% of 40,000, that's the 8,000, should be in operating expenses. So we can say cost of sales goes down by 8 and operating expenses goes up by 8. And that deals with the depreciation adjustment. Okay. Now then, let's think about the factory. Brought forward figure was 1200, and we've used that and depreciated in 2007. They need to depreciate that according to the question by 40. So it's got a carrying value of 1160, and we're told that we revalue every year, and we have a value to carry forward of 1350, and therefore we have 190 revaluation. And that's going to, the effect of that is to increase TNCA by 190 and increase revaluation reserve by 190, and of course that's going to be in our statement of changes in equity. The investment property, we need to consider that as well. We're going to revalue this every year, So investment property. It's in the records at 400, brought forward 400, and carry forward is going to be 375. So we've got a 25 fall in investment property. If I look at the statement of balance sheet there, non-current assets, investment properties in the records at 400, it should only be in the records of 375. So we've got a fall in the investment property, and we're going to take that to the income statement. So it's a decrease in profits in the income statement of income. Number 2. Past experience shows in the post-reporting period, the company often receives unrecorded invoices for materials relating. As a result of this, an accrued charge of contingent cost has been included in cost of sales as a current liability. The contingency, our past experience shows, but it's not certain. There's no certainty about it. It's not reliably measurable. And I'm going therefore to suggest that with this 75,000 accrued expense, I think we're going to have to reduce cost of sales by 75. And I just check and see, and it's included as a current liability, so reduce current liabilities by 75. It doesn't satisfy the definition of a contingency. So let's add that for number 2. Number 1, revenue includes 500,000 for the sale on 1st of April, the first day of the accounting year. Mature goods to Westwood. The goods had cost 200 at the date of sale. We can rebuy them on 2 years' time. 0708. We can buy them in 2 years' time for 605 based on achieving lender's return of 10%, and they're estimated to have a value of this is not a sale. 200,000 is not a sale, and therefore revenue is overstated. Revenue is overstated, so we need to decrease revenue by 200,000. What have we done? What have we done with that 200,000? We've debited cash, haven't we? What we have done is we've debited cash and credited sales with 200,000, and we shouldn't have done that because it's not a sale. That is wrong. The cash is right because we have received 200,000 cash. But the sale is not a sale, it's actually still in our stock. It should still be in our stock. So if it's not cash, if it's not a sale, what is it? It must therefore be a loan. And it says it's achieving a lender's return of 10%. So we need to debit sales. To correct this, we need to debit sales 200, and we need to credit the loan account of 200. And that gets rid of that bad entry by reversing it and putting it in, therefore, into a loan account. Okay, but it's also our stock, it's our inventory, so we need to increase inventory, and that means we're going to decrease cost of sales by 200, and we're going to increase inventory on this statement of financial position by 200. And we've also got the finance charge. We have a finance charge based on this loan of 200,000. It's a 10% based on a 10% return. Revenue includes 500,000. Why have I said 200? We've done 500, not 200. Sorry, guys. 200,000, 500,000, 500,000 reducing revenue, 500,000. Hey dear, so easy to pick the wrong figure up. Cost of sales is going to decrease by 500. The inventory is going to increase by 200. 200. Alright, the goods had a cost of 200. They were sold for 500. So what I've now done, therefore, is I've reduced sales by 500, reduced revenue by 500, which is reducing the profit by 500, but I also reduced cost of sales by 200. So the net effect is a reduction of profit of 300,000. But I've still got this loan interest. I've still got the interest on the 500,000 loan. And it's the 10%, and it's for a full year, so 10% of 500,000 is 50,000, and that's an additional increase, therefore, in finance costs, and an increase in the loan. At the moment, the loan is shown as 500, but it now needs to be increased by a further 50. And that, I think, is it. So we should be in a situation where we can start drawing the figures together. Revenue. Let me cross that out a second. When I was a student, when I was taught, there was always the guy who taught me, I remember him well, he said, you should reply, you should give the marker what the marker is after. It's a redrafting of the financial statements of Wellmay. So he would say, what you should do, don't you do this, Wellmay, draft financial statements. What's it for? For the year ended. March 2007. He said this should be in capital letters and this should be in lowercase letters. And he also said get yourself a ruler and a red pen and draw these lines and make it pretty, basically. A pretty answer will please the marker, and a happy marker is a generous marker. Well, this is what I was taught. This is the way I was taught to do it. But of course, when I was taught, there were marks of presentation. And now there aren't. If you look at any marking scheme from a past exam question, you'll struggle to find any presentation marks. So I'm going to take this out and say, don't you do this, you people. If you want, you could put Wellmay, but I think you're wasting your time. I'm not going to do it. What you could do is write statement of income, but I'm happy just to put SOI. That'll do. The marker knows what it is. The marker's seen hundreds of them before. And unless you're aiming for top spot, unless you're aiming for #1 position in the world, I would suggest that will do. In fact, we're looking at statement of comprehensive income, aren't we? Because we're redrafting the financial statements, and he's only given us a comprehensive income statement. So statement of comprehensive income, do you want to put for the year ended? I'm not going to, it's a waste of time. It's not worth it. Revenue, I wouldn't write revenue, I'd just write rev. The figure according to the question is 4.2, but now this is where it gets difficult for me. We've got the 500 reduction, but you see I've lost track, it's way up here, so I'm going to have to go swooping back up, see what else I've got for revenue adjustments. Nothing there. I should have written this, of course, onto my question paper, shouldn't I? Nothing there for revenue. Oh, there's a cost of sales of 40,000 in depreciation, so cost of sales is going to decrease by 8. Revenue reserves, investment property, cost of sales, again a decrease there. 500,000, that's just revenue minus 500,000. So 3,700 revenue. Cost of sales, per the question, cost of sales is 2007, but we've made a number of adjustments to that, haven't we? See if I can remember by going through the question. Yeah, we've got a reduction because of the increase in the closing inventory. There's a reduction for the 75,000, which has been included and shouldn't have been. There's a depreciation adjustment of 8,000, which is going to go to operating expenses. And I think that's it. Yep, that seems to be it. So 283 coming off that gives me 2417 cost of sales, which gives me a gross profit of 1283, and then I've got operating expenses. According to the question, that's 470, and while we're doing it, we might as well do investment property income. That's 20 per the question, and finance costs. Now, finance costs have got a number of changes. 55 is what we start with. Okay, let's have to go through this again. Operating expenses, no, but there was a finance charge, wasn't there? The finance charge of 50,000 on the non-sale. That 75,000 is dealt with. The factory operating expenses, that's this 8 been taken out of cost of sales and put into operating expenses. And we've got a loss of, I'm going to put the loss here, minus 25 for the loss on the investment property. There's nothing else there. The increase in the factory is going to go to revenue reserves. Balance on retained earnings profit for the period. No, that's simply an adjustment to that. The 8% loan, we had that finance cost. We've got an increase of finance cost. Was it 10% of 560 was 56 minus the 48, which has already been dealt with. So we have an 8 increase in the finance costs. There's a taxation adjustment. We'll do that as well while we're there. The tax charge for the question is 360, but we had the adjustment, didn't we, of 30,000, the increase in the deferred tax, and that's going to go then to the statement of financial position. And the 1 in 4 bonus, I think that's it. Operating expenses, therefore, 478. Investment property is now a negative expense of 5, 113 finance charges. I don't think I've forgotten anything, but we'll have to come back if we have. 580, 596, 596 off that is 687. Tax is 390, so 297 profit after tax of 297. So now I can go into statement of changes in equity. Changes in equity, and we've got share capital. What else have we got? Quickly, Mike, your time is running out. We've got share capital. We've got the equity element of the loan. We've got a revaluation reserve, which is there, and retained earnings. I think that will do us. Total share capital was 1200. Nothing in equity. Revaluation reserve was 350. Brought forward was 2615 for retained earnings. That gives me 384165. Brought forward. And then before I forget, I'm going to put the dividend in, 400,000 coming out of revenue reserves. Profit for the year 297. And we've got this 40,000 going into equity from the loan account. We've got 300,000 bonus issue, which has come out of the revenue reserves. 297 profit for the year, 40 into equity. 400 comes out of for the dividend. Nothing, no alteration there. Have I forgotten anything? Revaluation reserve. No. Revaluation, best experience, non-current assets. 100 and revaluation reserve. We revalued, didn't we? We revalued You silly man. You silly man. 297 and 300 from the... Sorry about that. Revalued the property by 190 from memory. Was that right? I'm going to have to go back up and check that. Revaluation reserve 190. Yeah. Okay, so that should give me 1500. This could be wrong. I don't know. 540. It could be wrong, but we'll have to see, won't we? 2615, 300, 100, 397 I'm adding on to that, which is 3012 and 193, 487, 87, 127, 4292. Does that cross add? 2, 549, 35, 40. Oh, 35, 41. No, it doesn't. 41, 1500, 3012. 2, 5 and 4 is 9, 30, 45, 50. Oh, dearie me, that's a lot out. 15 is 41, that's okay. Dividend. Stupid. 2. 2, 7 and 5 is 12, carry 1, 3 and 1 is 4. Yes, so that does cross add, so we're alright at that stage. And the only thing we've got to do now is a statement of financial position. And I must be running out of time, but I'm not going to check. Assets, I've got PPE. Per the question, it's 4,200. And we've just revalued it by 190. And we've dealt with the depreciation, so I think that's 4,390, but I'm still prepared to come back to it. We've got the investment property, and that was 400, but it's now 375, and I think that's it. So that's 4765. We've got current assets, which were 1,400. They've increased by the 200 stock, which I brought back in. So it should be 1,600. I can't think of anything else. So 6,365. It'd be a miracle if this balances, but nevertheless we'll carry on. Shares, it was 1,200, but we've put another 300 in there, so that's 1,500. Equity, we've got this additional bit of equity. Now I'm going to cheat a little bit here, because this should be the equity section of the balance sheet. We've got this additional equity of 40. We've got a revaluation reserve. Oh, come on, don't cheat. You can do this properly. 350 plus 190, 540. And we've got the retained earnings, which now I'm going to have to cheat on that one because there's too many adjustments. 2212, 2212 gives me 344292. Long-term liabilities, I've got the 8% loan, which we said was 600 minus the 40, but then plus the 8 interest, so 568. Then we've got the short loan on the non-sale. That was 500,000 plus the 50 interest, that's 550. We've got deferred tax. It was 180, but we've added 30 to it. That's 210. That's it, I think, for long term. Task 12, 1328 gives me 5620. And current liabilities, we've got 820. Was there anything else? Was there anything else? Yeah, those current liabilities included the 75,000 for the contingency, and that's got to come out. But otherwise, no, finance charge and loan. No, it should be. So that should be what, 740 7:45. Am I right? 7:45. It looks like it's 6365. And I've got 6365 there. So I've got a balance sheet which balances. I've done my income statement. 12:47 was the start time. 12:47 was the start time. 13:22 is the finish time. 12:47, 13:22. It's 22, 32, 35 minutes. That, ladies and gentlemen, is my presentation as well. That's how I would have done it. None of this stuff that I was taught when I was a student, none of this fancy presentation. It does make a difference, I have to say. It really does make a difference that if you feel that you have got the time, then things do look nice. I can't find a red colour. I better go back to my normal colour. But if you can imagine using a red pen and a ruler, straight edge, this could look really, really pretty. I personally prefer to put the commas into the 1000, use the 1000 separator. I do prefer it, but I was in a rush. I'd lost track of time. In fact, I would have had the time to make it very, very pretty. But it's not a big deal. If you can get this far within the 45 minutes, then I think you're likely on target for a pass.